The U.S. economy had a little growth spurt over the summer, up nearly 5% for GDP as consumers spent big. Benji Hire explains.
The U.S. economy growing much faster than expected, 4.9% in the last quarter, the biggest rise that we've seen since the last 3 months of 2021. The bottom line is consumers are spending. That's in spite of the Federal Reserve's efforts to curb that by raising interest rates, making it more expensive to borrow. A strong jobs market, though, has really made the difference here. It's touted as a success by the administration, and it's meant that Americans have been able to ask for more to be paid at the end of the month, more to spend, for example, on concerts, vacations during the summer. In a statement by the U.S. Bureau of Economic Analysis, it says the increase reflects accelerations in consumer spending. We knew that, as well as private inventory investment and federal government spending, amongst other factors. This is all a very far cry, it must be said, from the fears that the world's biggest economy could enter a recession. But it doesn't mean the trend's going to continue like this. It's not that this level of consumer spending is sustainable in any way. At some point, it may become more affordable to save instead of spend, especially given that in the coming days, policymakers at the Federal Bank, the Federal Reserve, the US's central bank, will be deciding whether or not to raise interest rates again. They're already at a 22-year high, and a bid to bring down inflation to the 2% target. Inflation at some point in the last year hitting a 40-year high. And what that could mean is it becomes costly to take money out and spend. There are a number of other factors that could play a part too, namely a series of strikes and walkouts that we've seen that could hamper next quarter's growth, as well as the fact that student loan repayments have resumed. For millions of Americans, that will cause a squeeze on their budgets, less disposable income, less to spend, less growth, of course. Now, economists do expect growth to taper off next quarter and next year, but many were surprised and proven wrong by the stats that we saw come out on Thursday. It is conceivable that they are surprised and shocked again when we see further actions by the Federal Reserve or stats that come out in the coming months. Benji High, CGTN, Washington.
All right, for more on the GDP, the U.S. economy, and what's in store for us, David Tawil joins us, president of Prochain Capital, financial services company. Good to have you back, David. I am so confused. We have inflation going down, which is what we want. We have the economy doing well, which I thought we wanted. We have unemployment low, which is generally good for people if you're looking for people to spend money. The stock market's upset about this whole thing, and I get it. The 10-year is a little higher, but it's not the end of the world. What's the negativity here about?
So look, the stock sell-off of the past 2 days, I think, is fear from a continued rise in interest rates by the Fed. But you're certainly right. Those folks that were calling for a recession, and this is the best recession that we've ever had, in terms of all those data points that you went ahead and mentioned, are all positive. And so they're, on the other side of the argument, however, those folks that have been bearish and continue to be negative in terms of where we are, believe that we're still waiting to see what the Fed has broken in terms of the effects of their interest rate policy and their hikes. There are those that are saying that we have not yet seen the pain points in the economy, and it takes time for those rates to work their way through.
We got the commercial real estate that's supposed to collapse. We got home prices that are supposed to collapse. We're supposed to have millions of layoffs. I get the end of the world scenario, but they've been saying, the bears that is, not you, the bears have been saying this since we started raising rates last year to where we, even from the beginning of this year. This is the worst recession ever that never happened, and we're almost going to will the economy into some sort of decline, aren't we?
I think there are folks out there that are certainly going to go ahead and do what you say in terms of willing it into a negative territory. But the truth of the matter is, you have to admit that the United States economy is a very slow-moving ship. And so you can't expect those things that are going to go ahead and constrain the economy to take immediate effect. We live in an immediate satisfaction, world now. But frankly, these things take time to go ahead and work their way through. And to your point, regarding commercial real estate or regarding highly leveraged companies, the debt on those things doesn't come due immediately. And so therefore, the higher rate environment doesn't translate immediately in defaults. We're seeing very high bankruptcy rates on a relative basis, year-over-year growth for corporates. I think that we will continue to see additional bankruptcies by corporations. And we're seeing a lot of defaults in the commercial real estate sector. Is it going to go ahead and cause a catastrophe, a recession, and bring the whole economy down with it? No, I don't think so. I think the Fed has threaded this needle quite well and will continue to go ahead and be able to reach what people have called and will continue to call a soft landing.
Right. I mean, look, for the average American, they could care less about what the short-term rates are because they're not a bank. We're not going to the Fed window to borrow money. They're getting home loans and car loans, right? And these are typically very long duration debt instruments. So when it comes to that, the 10-year where it is now, can the economy be okay next year with the 10-year at 5%? Because I'll leave this too. There are people who benefit from having the 10-year so high. In other words, if you're buying bonds right now, that's a big plus, especially those on fixed income.
No doubt. However, look to the other side of the spectrum, which is the asset purchasing, right? And the debt that people will have to go ahead and take on. We're already seeing a spike in auto loan defaults, and we're seeing a totally frozen housing market because mortgage rates are approaching 8%. And so will the economy suffer? Yes. If people can't afford, pursuant to their paychecks, to either buy automobiles or lease them or purchase larger, bigger houses, then the economy is going to suffer over a period of time. It's not going to catastrophically get damaged.
So David, if the Fed chair is listening to this, and you in particular, why would they continue to raise rates? Well, what's the reason to raise rates, whether in November or December, or quite frankly at all next year, if there is enough pressure already?
The Fed has been absolutely clear. They're looking to get their sole objective is to get to a 2% inflation rate. We're not there yet. That's it. That's all they care about. They want to see unemployment go up, obviously, because that will help with respect to bringing down inflation. But all they care about is getting inflation lower. And if they see the economy is hot, like we saw from this GDP read, they see themselves as having additional ability to raise rates in order to go ahead and put a harsher, weight on inflation.
So we're rooting for bad news on the economy. David Tawil, I could go on about this. We're out of time. Thank you. Appreciate your insights on this.